Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, and one of the founding partners of the Dividend Kings marketplace service on Seeking Alpha. I'm kind of excited about today's video because what I'm attempting to do here is primarily illustrate how you can value very fast-growing stocks. In the past, I've often talked about how a PE ratio of 15 represents a good fair value reference for most companies. But so additionally in this video, in addition to how to value fast-growing stocks or growth stocks, I also want to talk about some of the nuances of valuation, because fair value doesn't necessarily indicate that you're going to make a good rate of return. It's buying a stock at fair value is really a measurement of soundness, and then what the company does as an operating business after you make that decision is what's going to really determine your rate of return. So I'm going to start out here by looking at American Express to kind of talk about this fair value 15 PE ratio. The orange line on this graph is a plotting of each of the company's earnings per year at a 15 PE. So this is my fair value reference. It means that, when the stock is trading on the line, when the price is touching the line, the stock's at fair value, but it doesn't mean that fair value is a good buy, because you could buy the stock here at fair value, and I want you to notice that earnings over the next couple of years going through the recession fall, and even though the stock kind of tracks fair value, it's not necessarily a good rate of return. So let me illustrate that by putting monthly closing stock prices on the graph. Now, what I want you to notice here is this tendency of the stock to go where the earnings go, first of all, but they also continuously revert back to this normal mean, if you will, PE ratio of 15. You see some overvaluation here, eventually comes back to 15. This is what I was illustrating, that you could buy a stock at a 15 PE and it could still be a poor investment because the future growth of earnings aren't good. And here you have a perfect, PE of 15, just slightly above, and yet for the next couple of years you'd have lost money because earnings fall. But what I really want you to see here is the nuances of valuation. Valuation is not about making money, it's about being prudent and sound with your investing decisions. So now let's move on and talk about some exceptions to the rule. In the written part of this presentation, I showed 3 companies that basically were exceptions to the rule, if you will. So what I've done here is, first of all, I'm showing you Echo Labs, and I've drawn this normal 15 PE ratio valuation reference. And I want you to notice that the stock really has never touched that. Now, the price still kind of goes where the earnings go, but what I've got to bring in here is a normal PE, and it calculates out at 26.8. In the article, I called this 25-ish. I want to make that point here with this video. This is a valuation reference. I simply know that this is a PE of 26.9, rounded 26.87 to be precise. And so, here I'm going to have PEs lower than that. Here I'm going to have PEs slightly higher than that, and so on and so forth. But approximately a 25-ish, 26-ish PE ratio has been fair value for this stock. Now, I don't argue with this. I simply recognize it as a fact. So if I'm going to invest in Echo Labs and really want to own it, and it's obviously a superb company with very consistent growth at over 11% a year. It's an A- rated company with 40% debt, but the valuation, you can see the moving back to this more normal PE here. So for whatever the reasons, the market does like to apply a premium valuation. I still don't totally discount my 15 fair value PE and call it worthless at this point. I simply recognize that this is an exception to that rule. A second exception to the rule that I illustrate in the article is ADP. Now, here's slightly different. Once again, we see very high valuations here. The market has rarely valued the stock at the 15 PE, but it has, in this example, done so on a couple of occasions. It did it coming out of the recession of 2001. We could have picked this stock up at somewhere within a reasonable range of that 15 PE. And then for a few months during the Great Recession, we could have bought the stock at a 15 PE. And that would have been optimum times to buy the stock, but also very rare times. So normally, if you want to invest at ADP, you got to be looking at paying something like a 20 PE ratio. And again, I've got 22.85 drawn because you got to have pure math, but you can see a 20 PE would also be relevant here. Now, the third exception to the rule that I showed was Cisco Corp, the institutional food delivery company. And here again, you see a normal valuation by the marketplace of a PE somewhere in the 20 range. But I did have, in this case, a couple of years where I could have bought this stock at an attractive valuation. So the decision an investor has to make when they run into these kinds of exceptions is, do you really want to pay these high valuations to buy a stock like this, even though historically it's been a reasonably prudent decision? So that's one nuance or exception to fair value PE that I wanted to illustrate. So now I'd like to go ahead and move on to some growth stock ideas, because growth stocks are really valued differently. I want you to notice the formula that we use for growth stocks is price-earnings ratio equal to growth rate. What you see here over this time frame is Nvidia grew at 32.6%. That's the average growth rate of earnings. Therefore, we drew the orange line with a PE of 32.6. And incidentally, in this particular iteration and example, we ended up with a normal PE of about 30.95. So, 30 to 33 times earnings becomes a normal fair value for Nvidia. Now, I do want to show you some interesting things with this example. If I use my scroll bar here, obviously we had this huge surge in earnings, and we had this really big surge in market price. So first of all, if I just take my scroll bar here and I scroll out that surge in earnings and look at Nvidia from a standpoint of what its earnings growth was like from the period 2000 through 2015, we see that although it was somewhat lumpy, earnings growth was 26.69%. Now that's above a 15% growth rate. So once again, we apply the PE equals growth, or in this case, we draw the orange line at a 29.69 PE. And what I really want you to get here is that this becomes a very rational fair value reference. You can buy this stock at this higher PE, and you will be buying it at value because it had tracked that over time. But next, I want to show you something very interesting in terms of growth and how valuation adjusts as growth rates change. What I've done here is I've shortened the time frame going back from really 2010, or the end of fiscal year 2009, and their fiscal year is January, by the way. And I noticed the growth rate adjusts to 23.9. And now we get a fair value reference over this time frame, but we also see what appears to be a period of very high valuation here. But what's anomalous about that is we had very, very high growth going on during this period of time. So if I make some adjustments here and take out some of that time, you see that this, what really looked really overvalued a second ago, only looks moderately overvalued here. But then we had a correction in the company's operating growth rate, or a minus 16% growth for fiscal year expected this year, and we see this huge correction in the stock. So valuation adapts as growth rates change. So now let me move on to O'Reilly Automotive. This is a very, very consistent grower. I want you to notice the operating earnings growth rate was 19.3%. So now I'm drawing its P equals growth rate. So I'm drawing the orange line at a valuation reference of 19.3. And I want you just to notice how impeccably almost, a perfect correlation for all these years. We get a period of overvaluation, we get a reversion to the mean, and then we have some acceleration in growth going on here, and the stock kind of gets ahead of itself again. But the point is, what I've got here, when I'm looking at this graph over this time frame, I'm seeing that 19 times earnings from a historical perspective has been a very, very sound valuation reference to utilize if I was looking at O'Reilly Automotive. Now let me move on to Cognizant Technology, another high growth stock. Growth rate has averaged 26.8%, and therefore I'm drawing the PE at a 26.8 multiple. And again, you see that the price correlated with that very closely, but I want you to notice that we started to see a disconnect here where the price no longer really relates to that 26.8 PE ratio. However, if I look a little closer and I look down here at the bottom of the graph, I can see that the growth rate has been changing. So if I chop some time off of this graph, instead of 26% growth, all of a sudden now I've got 17.7% growth. That's still above 15%. So now my tool is drawing a PE ratio of 17.7, and all of a sudden it becomes a very, very relevant and very, very sound valuation reference for this stock since 2007, or since just before and then just following the Great Recession. So at this point now, I've adjusted my valuation reference because of the changes in the company's growth rate. And I think that's very, very important. When you're valuing growth stocks, you got to recognize that these very high rates of growth typically don't go on forever. So let's move on here and let's look at Alphabet or Google, and we're going to see something very similar to what we just saw with Cognizant. If I take the long-term view, Google's been public since 2004, and if I look at this long-term view, they've averaged 37.4% earnings growth. And so I see that, that I'm drawing the PE. Now that PE had relevance back here, but look at the growth rates back here, ladies and gentlemen. We had this huge level of growth. And then we started seeing growth tapering off as well. So again, if I cut some time off of this graph, all of a sudden I discover that since 2007, the company's only grown at 18.8%. And that has been a very attractive valuation. I've got a PE drawn here as 18.8. Please understand as I'm going through this that the value or the multiple of this orange line changes and adapts to the growth rate of the company. Okay, and as the growth rate, changes, now here all of a sudden we're seeing growth of 13.5. That's below 15%. So now we're starting to apply a 15 PE. Now we do see that the market has continued to apply a high valuation to Alphabet, but the company's growth is definitely changing, and that should be a warning or a forewarning that you need to be making your decisions looking at forward growth. Near-term estimates are for the company to average 14% growth going forward, but I don't think I would continue to apply a very high normal PE of 24 times earnings. I need to make my adjustment and start thinking about this company as perhaps a 15% multiple going forward. Now let's carry this forward to one of the fastest growing stocks on the planet over the last decade or so, or of course at least since 2012, which is Facebook. Here I've got 35.96% growth. So I'm drawing the PE again at a 36 multiple rounded, 35.96 rounded. But once again, I see that more recently, the company's stock price hasn't correlated with that because now as I shorten the time frames here, the growth rate falls down to 30%. And again, if I'm looking at this company going forward, the growth rate is expected to get, to slow down quite a bit. Remember, we've got a 570, we'll call it $3 million market cap. Now the long-term trend line growth is still 17% growth. And so there still could be money to be made in owning a Facebook now. But if you bought it today, you would be paying a relatively high valuation. So, what I've done by showing you the past here so far is pointing out that the results that the company achieves will be the determinant or the generator of the returns. So therefore, it logically follows if you're going forward, you want to be thinking about what the growth potential is going forward. And if you buy this 17 or 18% growth, then you want to consider, Facebook as a 17 or 18 multiple company or somewhere within the range of these orange lines here because valuation is never perfect. Now I want to close this video by taking a look at Amazon, which obviously is a juggernaut, an $860 billion company, total enterprise value just under $1 trillion, $900 billion. But the point is when I look at it from an earnings point of view, this company's stock price really doesn't correlate or track its earnings very well. Now I'm going to get rid of a couple of years here of anomalous data, and I'm going to move on. I'm going to take a look at operating cash flow of Amazon. The founder of the company, Jeff Bezos, talked quite a bit about the fact that he was interested in generating cash, but he's reinvesting the cash and he keeps buying new businesses, and consequently his earnings have been very spotty. But if you look at operating cash flow, you see that operating cash flow growth has been just under 31%. So I'm drawing this using that same priced operating cash flow equal to the growth rate formula here, and we see that a 30 times cash flow valuation for Amazon makes a great deal of sense. Stock's currently trading at just under 25 times operating cash flow, which would indicate that on that basis it might be attractive. And if I look to the future, the market expects 26% forward growth, long-term trendline growth of operating cash flow, which would mean that Amazon looks attractive today. Now, I would also get a similar picture if I looked at it as a softer form of cash flow, I like to call it, which is EBITDA. EBITDA is expected to grow at 26%, and I looked at how the market has valued this stock based on EBITDA. I find out that I've drawn the normal price to EBITDA line here at about 39.8 because that's how fast Amazon has grown it. So what I'm getting here is I'm putting the puzzle of valuation together. Amazon has clearly been an unbelievably successful investment. It's way outperformed the markets. It's, if I look at it from inception, if I go all the way to inception here and look at it from when the company started, it's been just a really powerful performer. But the point is that I'm looking for when I can buy this stock to where I can participate in the growth of the business. And I don't want to overpay for it because then even if the company does well, I I don't do as well. And if I get a chance to buy it when it's cheap, I can actually do better with my money than the company does. So when you're valuing stocks, you also have to take into consideration the growth of the business, but you also have to recognize that that growth is dynamic and that it changes over time. And so as you draw different time frames, notice that the adjustments will be made. These turn out to be very excellent kind of rules of thumb or foundational valuation references that you can rely on to help you make better long-term investment decisions. Anyway, this has been Chuck Carnevale saying thanks for watching. I appreciate it, and I'll be talking to you again soon with another video.